Hi everyone, welcome back to Crack Grade B. So in today's lecture, we are going to talk about the newest SEBI decisions that have been taken, the recent highlights of the SEBI's board meeting, right? We are going to discuss on the various components of the following meeting, what have been the decisions that have been taken, starting with number one. There has been an extra focus on the ESG related guidelines, right? What is ESG? So your environment, social, as well as the governance related things. Fine. So number one thing that you're going to see over here is that in order to enhance the reliability of your ESG disclosure, SEBI has said that BRSR code needs to be introduced. Now, what is this BRSR code? So this is about the business responsibility as well as sustainability report. Now, I'll throw some light over this also. What is this? So understand this, in today's world, we are just 7 years far from when climate change is going to be a reality. So in this particular situation, what we actually want to do is these listed companies should understand that they have a responsibility to the environment, towards the society in which they are operating. So this particular BRSR code is nothing but this is just a reporting framework, right? Your listed companies, they have to report that whether they are ethically complying with all the guidelines or not, whether they are taking care of employees or not, whether they have been following the environmental related regulations or not, how green are their activities, etc, etc. So all of these are part of your business responsibility and sustainability report code. Fine. SEBI says that this particular following, you as a listed entity, you have to include this particular report in your disclosure related things, correct? Like you disclose your financial statements, you give your financial statements to the investors to understand it, right? So in the similar fashion, this particular report also should be brought out by you, and it is going to tell the investors as well as the other stakeholders that how green your activities are. Understood? So what are the requirement of compliance? So SEBI says that it is going to begin with the 150 top listed entities. Top listed entities means the entities which is having the highest market capitalization. Top 150 entities have to comply it from the year 2023 to 2024, and after that it will be extended to the top 1000 listed entities by the year 2026. So this is the guideline that has been told by the SEBI. Now after that, see, there are many companies. India has said that India is going to become carbon neutral by the year 2017. Likewise, various companies also have provided their timelines. Like Reliance has said that it is going to become carbon neutral by the year 2035. Similarwise, TCS as well as the other companies, they also have provided their timelines that by this year we are going to become carbon neutral. But why these companies are doing like that? Because there is an environmental responsibility onto these companies. Now understand this, the value chain related concept. Value chain related concept means, like for example, your Apple, correct? Apple has got its base in USA, but it manufactures as well as assembles its devices in various countries. Fine. So value chain goes like this. Raw material is sourced from another country, it is getting produced in another country and then assembled in some another country, like that. Fine. So this is called as value chain. So it has been realized that there are various listed entities whose value chain is using so much of environmental resources, right? So that's what they are saying over here. There are number of companies which have significant ESG footprints. ESG footprint means in their value chain they are using environmental resources, and hence they are responsible towards the society. For such kind of companies, SEBI has said that they also have to follow this particular reporting requirement for their value chain, starting from the top 250 listed companies, correct? It is going to comply with this from the year 2024-25 onwards. First of all, it is going to be applicable on a comply or an explain basis. Either you comply or explain that why you do not have complied. That means a voluntary kind of thing that will be done away if you provide an explanation. But after your 2025 onwards, it is going to be mandatory. So let me sum up this. If you are a company and you are having value chain means starting from the raw material supplier. If you are somewhere in the value chain, your value chain is using environmental resources of our country, then you have to follow this particular reporting requirement. You have to fulfill your environmental obligation with respect to your value chain activities, right? And this is going to be started from the top 250 listed entities. Next, we have something called as ESG ratings. Now understand this, what happens is, right now the credit rating agencies, they provide the credit ratings on the basis of what? On the basis of whether this company is going to repay the debt or not, whether it has repaid into its previous times or not. That means by way of credit rating, the credit rating agencies tell that what is the financial risk involved if you are going to invest in a particular company. Understood? That was the concept of credit rating. I know that all of you must be aware of credit rating agencies. So in the similar fashion, now this particular concept of ESG rating is also gaining boom, right? Your international organizations which are related, which are regulating the capital markets, they also have said that we have to make the regulations, we have to make the standards, and we have to bring out such kind of rating providers who do specifically ESG ratings. ESG ratings means they give, now suppose if there is a thermal power plant, correct, what kind of ESG rating I am going to give it? I'm not going to give it a good ESG rating. Why? Because in future, coal related uses are going to be reduced down, and hence there is a high ESG risk with this kind of organization. So under ESG rating, you rate an organization on the basis of its activities, how sustainable are its activities, and whether high ESG risk is involved along with its activities in future or not. So this helps the investor that they can take better decisions. They can take environmentally sustainable decisions. Now see, in today's time, funding is also coming to such organizations who are doing environmentally sustainable activities. Now, many of the brands in today's time, you might have seen that they say that we are very environmentally conscious, we take these kind of steps, that kind of steps. So this is all called as being environmentally responsible, and hence government also wants that such companies should become ESG rated, right? So for that, here is the next provision. Considering that emerging market have different set of environmental challenges, ESG rating providers, just like credit agencies we have, the similar kind of concept we have with ESG rating providers. So government of it, your SEBI says that dear ESG rating providers, please consider we are an emerging market, right? We are a developing country. We all have our some limitations, like in a developing country, resources are limited, funds are limited, right? Population is high and there are huge environmental challenges. So we want you to please rate us by considering us as an emerging market. Fine. This is what they are saying. And next, ERPs, that means your ESG rating providers, they shall offer a separate ESG rating called as core ESG rating. Core ESG rating means which will be focused on the your BRSR code. All those entities which are following this, on the basis of that, these entities have been instructed by the SEBI that they should bring out a separate kind of ESG rating which should be linked with the parameters of BRSR code. Now what are these parameters? What is this BRSR code? So please listen to me again very carefully. BRSR code means it is a reporting requirement, right? Under this, you have to match your financial results and you have to compare it with how sustainable you are, how sustainable your environmental practices are. Correct? So that means you are comparing your financial results with the environmental sustainability. This is the crux of your BRSR core, right? So on the similar fashion, whatever the requirements are given under the BRSR code, the SEBI wants that your ERPs, that means the rating providers, should come up with such kind of rating which should include all parameters that have been mentioned in this particular report, in this particular reporting requirement. I hope it must be clear to you. Now, jumping up to our next topic, see what happens in today's time is every company says that, oh, we are very sustainable company, we are very environmentally conscious company, and we always take care of environment, please invest in us, right? So every entity shows whatever needs the financing, it shows that we are ESG compliant, ESG governance compliant, and please invest in us. So in order to remove such kind of mis-selling, such kind of false propaganda, SEBI has said that it is being mandated that ESG schemes to invest at least 65% of the assets in listed entities where BRSR code is undertaken. Now, two things over here. If you are a company which is running ESG scheme, ESG means it is a kind of investment scheme which tells that we invest in the environmentally sustainable companies. Okay, so if you are an in company, you are running an ESG scheme, right? You are taking money from the investors by telling them that please do not worry, we are going to invest this money into the entities which are green. Green means their activities are green. Fine. So SEBI says that if you are claiming that you are an ESG scheme, then at least 65% of your assets, that means the securities that you have invested in, should be in such listed entities which are following this BRSR code. That means which entities which are following this particular reporting requirement. Correct? So this is the mandate of this particular scheme. Now let me simplify it a bit more for you guys. See over here. You are a company. You are taking money from the investors, right? You are taking money from the investors. You are saying to them that we invest in good companies or the companies whose activities are sustainable. So now SEBI has said that if you are collecting the money from the investors, then please ensure that at least 65% of your assets, that means the investments that you have made, it should be in such companies, in such listed entities which are following BRSR code. I hope now it is clear to you, right? Now moving ahead to our next topic. This is a facility. What is this facility? The facility's name is ASBA, Application Supported by Blocked Amount. Now this facility was there for the IPO. What was this facility? So I'll tell you. So suppose I am an investor, right? I want to invest in an IPO. A company has brought out its IPO and I want to invest in it. Correct? But there are chances that my application might get rejected. Correct? So for that, this facility was brought out that your whatever amount you want to invest in IPO, that amount will be blocked in your savings account, right? That amount will be blocked into your savings bank account. You cannot use it for any other purpose. And when your capital will be up, your application will be approved by the company. Suppose I wanted, there is a company ABC Limited. ABC Limited is bringing out its IPO. I want to invest in ABC Limited. So what I did was, I said, I gave this particular application to the SEBI, right, under ASBA, and what they said that, okay, fine, you want to invest for 10,000 shares, okay, your application amount is blocked in your savings bank account only. We are not taking this amount right now. When the company is going to approve your application, at that particular time amount will be deducted from your account. So it is a win-win situation, right? I do not have to pay the money beforehand. This is just like cash on delivery. Once your application gets accepted, at that particular time money will be deducted from your account. And in this meanwhile, till the time application is not approved, my money will be blocked. Fine. This is like a mandate that you have to maintain this particular money, because this money can be deducted at any particular time. Cool. Now this was there only for the IPO process. Now this thing has been brought in for the secondary trading as well, secondary market facility as well. So as an investor, if you want to do the trading, correct, you have to your amount will be blocked. For whatever amount you want to do the trading, your amount will be blocked for settlement purposes, right? And this is also, this is optional. As of now, this is optional. What is this facility? So this facility is blocking of funds for trading in the secondary market through UPI platform. Your funds will be blocked. It will be deducted once the trading actually happens. Fine. In the meanwhile, the customer will be eligible to get interest on the block funds. Obviously, the market has not taken up the money from my bank account yet. The money will be deducted when trading is going to happen, or when the settlement is going to happen. At that particular time, money will be deducted. And for the remainder of duration, till the time money is not being deducted from my account, I will be eligible to get interest. Correct? Because money has just been blocked, it has not been deducted from my account, so I will be eligible to get the interest. Next is, this fund can also be used for the margin and settlement obligations. You all know that if you are trading on an exchange, there is certain money that you have to provide for the as a margin money, right? Because if you fail to settle any obligation of yours, then clearing corporation can recover the fund from here, right? So now the blocked fund for which the facility is being provided, it can be treated as a margin money as well. Some blocked funds, they can be used for margin money as well. And because of this facility, now the working capital requirement will be reduced. Your money will not be blocked in different locations. Understood? There will just one blocking of money for the trading that you are doing, and all the obligations will be fulfilled out of that. Understood? Now next thing, see, this is a very small piece of information. So what happens is, stockbrokers as well as the clearing members, they have clients' money with them, right? So this is being said that if you are a stockbroker or a clearing member, and stockbroker who is not a bank, non-bank stockbroker, you are a non-bank stock broker or a clearing member, correct? So client money is with you, Now there are chances that you can use the client money for your own purposes. So in order to mitigate such kind of risks, SEBI says that if you are a non-bank stockbroker, or if you are a clearing member, then what you can do, please give the customer's money back to the clearing corporation at the end of day, so that you do not have any amount of customers money. Obviously this kind of regulation is not applicable on the stockbrokers which are bank. So bank based stockbrokers means the stockbrokers which are working also as a bank, on them this kind of requirement is not applicable. So this is what it is being said, that client's fund shall be upstreamed by the stockbroker or the non-bank clearing members to the clearing corporation on the end of day basis, so that so that clients fund are not retained by the stockbrokers or the non-bank clearing member. Understood? This is very simple. This has been said that please do not keep clients money with yourself, give it to clearing corporation. Fine. Now the framework, it is not going to be applicable on the clearing members who are bank based, right? And for the proprietary funds, proprietary fund means the funds that is belonging to them. Obviously they are doing the business of stockbroker and clearing member, they must be having fund of their own. So their own proprietary fund, they do not have to give it to clearing corporation. Just clients fund, do not keep with yourself, give it to your clearing corporation. Understood? Now next is, and this particular this is going to be implemented in two phases. So phase 1, just wait for a second, did I miss anything? No, I did not. So this is going to be applicable in two phases. First phase is going to be implemented from the July 1st 2023 onwards. Now a very vital piece of information. What is this piece of information? So understand, what is the meaning of alternative investment fund, AIF? So these AIF, you can call them as a supra fund. They invest in debt funds, right? Equity funds, hedge funds, venture capital funds, like that. And from where they get the investment? They get the investment from the investors, high net worth individuals. Like in mutual funds, small retail kind of investors, they invest. But in alternative investment funds, your high net worth individual, being institutional investors, they invest in alternative investment fund. Now I'll tell you what. So in India, Indian government wants to deepen the debt market and bond market. We want to promote it. Why do we want to promote it? Because there are various benefits through this, infrastructure development can happen, etc., etc. Right? But the problem is, what happens is, in the tough times, nobody is ready to invest in the debt market. So if government wants that the debt market or the bond market should reach towards the height, so it only has to take the certain steps. So it has taken. Now what is the step that SEBI has taken? Let's see. See over here. So board has approved the amendments to the SEBI Alternative Investment Fund, and board has said that we are going to develop a corporate debt market development fund. A fund has been developed. Please see very carefully. A fund has been developed. So it is how, in what form it is going to be established? It is going to be established in alternative investment fund format. That means you are going to take the funds from the investors who want to invest, and then you are going to invest in the debt market. So this is being said by the SEBI that we are going to utilize this particular fund to invest in the debt market in tough times, when in capital market times are not good, right, nobody is ready to invest in the debt, at that particular time we are going to take the funds out of this particular fund, means we are going to take the money out of this fund and we are going to invest in the debt securities which are of investment grade. Investment grade means we are referring to credit rating. If you have got a credit rating of being eligible for investment, then we will be investing. See over here. So this is a facility through which we are going to purchase investment grade corporate debt securities during the times of stress. So such kind of issuers, that means the companies whose debt securities are of investment grade, that means they have not so much defaulted in the past, they have got a good track record, so we want to instill the confidence in such kind of issuers, right? So that is why what we are going to do, we are going to establish this particular fund, and this particular fund is going to be used to invest in the debt securities. Is it okay? So now let's move on. One more thing that is there. Just wait for a second. So this particular fund of your, this particular fund is also going to be guaranteed by the National Credit Guarantee Trust Company. And because of having such, what you can say, a huge amount of guarantee, this particular corporation has got its own name, fine. So we can totally say that this particular fund has got the sovereign backing, so it is going to push your debt market to a newer heights. So this was the next. Let's move towards the next piece of information that we have. And why this piece of information has been brought in, let's understand this. So whenever you might have seen in the recent Adani case that whenever any kind of even a rumor comes about a listed company, it has a negative impression on the stock market, right? Stock market goes down and there is volatility in the stock market. So in order to prevent all of this kind of scenarios, SEBI has came up with few disclosure related guidelines. So SEBI says that if you are a listed entity, then you have to tell that whatever decisions has been taken under the board meeting within 30 minutes and which are emanating from within the listed entity within 12 hours. That means if board has taken any decision, you have to disclose it within 30 minutes. If a decision has been taken in the entity that is not directly related to the board meeting, but it is that kind of decision is having its origin from the entity, in a simpler term, the decision has not been taken directly by board of directors, but the activity has been done by the listed entity. If you have conducted any such kind of activity which is material, you have to disclose it within the 12 hours. After that, there is also a requirement. What is that particular requirement? It has been said that if there is any kind of market rumor, it has to be verified, denied, or clarified by the top 100 listed entities with effect from October 1st, 2023. And this is going to be increased and reached out to the top 250 entities from the April 1, 2024 onwards. You have to clarify the market rumors immediately. Why? Because this has a negative impact on the stock market. It impacts the market negatively, and SEBI does not want the volatility in the market. So hence authorized information is required. Next is timeline to fill up the vacancies of directors as well as the other officers. So SEBI says that if any post is vacant because of director, compliance officer, chief executive officer, or chief financial officer, such post needs to be filled up within 3 months. You cannot delay. You cannot, because this is an important post, hence you need to fill up within the 3 months of such vacancy. Now the next piece of information that we have is related to the bonus issues. So certain changes has been made to the issue of capital and disclosure related regulations. What it has been said that if a listed entity is announcing bonus issue, first of all it has to take the approval from the stock exchange. If you want to announce the bonus issue, take approval from stock exchange and then announce. After that, your bonus issue is going to be in dematerialized form only, electronic form only, correct? So this has got nothing to explain because these are self-explanatory. Now this is something we need to explain. So this is, you can call it as ease of doing business related measure. What is this ease of doing business related measure? So suppose if you are a company and you are issuing bonds or commercial papers, then the process has been made simplified for you. There are two documents. Number one is general information document and then you have key information document. Fine. So if you want to issue bonds or commercial paper, what you can do is this GID, general information document, it will going to contain the information which is specified under the common schedule and it should be filed with the stock exchange at the time of first issuance, and this is going to be applicable for 1 year, right? So within a period of 1 year, whatever kinds of bonds, commercial paper you are going to issue, you do not have to file the general information document again and again. General information like your company related informations which are not going to change issue from issue, they are not going to change. You are going to remain the same company, your directors, your shareholders, etc, etc, such kind of informations. But with every issue some key informations change, and for that, whenever you are issuing the bonds, right, suppose after 6 months, after 3 months, after 4 months, or whenever you are issuing the bonds, you have to file your KID. Correct. So within this validity period, only a KID has to be filed with the stock exchange, which is going to contain the material changes. What are the material changes? What are the key changes? Now, what is the amount you are going to take up? What is the maturity period of the bonds? What are the commercial paper? What are the objectives? What is the maturity period, etc, etc. So these are the twin documents has been introduced for what? Issuance of bonds as well as commercial paper. You can compare them with the prospectus or information documents that we file whenever we issue any kind of securities. So GID is going to be valid for 1 year. You just have to file it once and it is going to be applicable for 1 year. And in between time, if there are any kind of material changes, that you can file under the KID. So this is proposed to be made applicable on a comply or explain basis till March 31st, 2024, and it is going to be mandatory thereafter. Right? I hope you understand the comply or explain basis, that this particular period of time, yes, it is voluntary. You can call it voluntary, but at the same time, if you have not followed, then you have to explain. Either you comply or you explain that why you have not followed. And after 31st March 2024, it is going to be mandatory only. Next, so in 2019, again, see, India wants that Indian companies should take up the debt as well as the bond related market route. We want that our companies should borrow through the debt market. They should they should fulfill their funding requirements by borrowing from the debt market. So that is why SEBI has mandated, to whom SEBI has mandated? So SEBI has mandated the large corporates. Correct. Now, what are these large corporates? So, these large corporates are those who are having a borrowing of 100 crore rupees or more. Correct. So, these companies, SEBI has said that please take 25% of your incremental borrowing from the debt market. Incremental borrowing means such borrowing which is going to have a maturity period of more than 1 year. And along with that, what kind of debt they can issue? So these companies, they have a debt of rating AA and above. Correct. So these companies are called as the large corporates. Incremental borrowing, I have already told you, incremental borrowing means the borrowings which are for a period of more than 1 year. So SEBI has said that please borrow from the debt market, but these companies have not been not been able to fulfill the criteria. 34% of the companies that were eligible to borrow, only 34% has borrowed it. So that is why SEBI has said that the 2 year time period that we have given to you in order to comply with this, now we are extending it and we are making it 3 years. Summing it up again, large corporate means those corporates which are having a borrowing of more than 100 crore, right? And such kind of borrowings having a AA rating or more than that, correct? And they have been said that please borrow from the debt market having a maturity of more than 1 year. At least 25%, 1/4 of your funding should come from the debt market. But the companies have not been able to comply with that. Only 34% of the companies who are eligible have been able to comply with. That is why SEBI has increased the timeline. SEBI has said that now please comply with these particular requirements within 3 years. Right? Earlier it was just for 2 years. Now it has been extended to 3 years. Now next is the board decided to extend the comply or explain period for high value debt listed entities in respect of corporate governance norms till 31st March 2024. So corporate governance norm was made applicable on the high value debt listed entities, right? And these entities, the norms has been extended. So corporate governance norm, if you are complying it, good. If you are not complying, that you have to explain. Now what are these high value debt listed entities? Number one is these are listed entities. Number two is they are having a borrowing of at least rupee 500 crores or more. I repeat, these are obviously listed entities and they are having a borrowing of 500 crore rupees or more. So such kind of entities are known as the high value debt listed entities. Please remember the full form as well. Next is this particular requirement is regarding with alternative investment funds, right? Alternative investment funds which are having the corpus of more than 500 crores, they should dematerialize their securities. That means all of their securities should be in the online format by the time October 31st 2023. If any fund that is having corpus of less than 500 crores, they have to comply with this particular requirement by April 30 2024, right? Easy. Now next is so I'll just not very important, just a little bit piece of information is important. See, as an alternative investment fund, I have told you, you take money from the investors and you invest somewhere else, right? Now suppose wherever you are investing, there is conflict of interest. Conflict of interest means it can arise because of the managers who are managing these. It can arise due to ownership. Suppose a person who is involved in the management of AIF, he is holding the shares into the company where they are investing. So such kind of conflict of interest investments can arise, and if there is a situation, then alternative investment fund can invest in such conflict of interest investments also, but they have to take approval of 75% of the investors. If 75% of the investors they say yes, you can invest in even in such shares as well as securities which are involving conflict of interest, then you are good to go, you can invest. This is what SEBI says. And the 14th number of point, this is relation to, see, There are some alternative investment funds which invest in venture capital funds and like that kind of funds. So if you have invested in venture capital funds, these kind of funds, these are not liquid, right? So if at any particular point of time you want to sell it, you might not be able to. So at the time of liquidation, suppose if there are certain investments, like your AIF has done investment in a venture capital fund, assume you have made the investment in a venture capital fund which could not be sold due to the lack of liquidity during winding up process. So here your SEBI says that if you can sell, you can allow the AIFs to either sell such investments to new schemes of AIF or to the same scheme, right? But you have to take the approval of 75% of investors by value. What we are trying to say over here is that if you are not able to sell any kind of investment due to the lack of liquidity, then you can afterwards, but you have to take the approval of 75% of the investors by value. And lastly, we have this, a small piece of information is there, that SEBI says that mutual fund cannot double charge the investors in the name of total expense ratio, and they clearly point out that brokerage which are paid to the distributors should not be included under total expense ratio. I'll tell you how. See, there are distributors, there are investors, and then there are mutual funds. Whatever services mutual funds provide to the investor, for that mutual funds charge a particular amount, and that is included in the total expense ratio. So whatever money investors give to the mutual fund says that we are going to charge our fees as well as some other administration expenses in form of total expense ratio, right? At the same time, mutual funds give commission to the distributors, or you can call it as brokerage as well. Why they give brokerage? Because these distributors, they sell mutual fund schemes to the investors, so they take commission from here. And these distributors, they also take commission from the investors. So you see, there is double burden on the investor. Investor is paying the commission to the distributor, and after that, these mutual funds, what they do is, this particular commission what they are paying to the distributors, they include this expense also over here. They do not bear it on their own, they include it here and they pass it on to the investors. Now investor is bearing double burden. Double burden means he is giving the commission to the distributor, at the same time he is bearing the burden of this commission also, which is included in total expense ratio. So SEBI has said that this is not going to be allowed, and you cannot double charge from the investors, and SEBI has said to change it. So these were the some highlights of that has been discussed right yesterday in the SEBI's board meeting. I hope that you must have understood the points that I wanted to discuss. Even if something has you might not be, if you have not been able to understand it, please feel free to write to us. We will be happy to answer. Correct? You can write in the comment section as well. So I hope this would have helped. If it did, then please do not forget to like this video. Thank you.